Global markets moved sharply after the latest escalation between the United States and Iran, and investors across America are now watching two assets more than anything else: oil and gold. Whenever geopolitical tension rises in the Middle East, energy markets react almost instantly because the region controls a massive share of the world's oil supply. The moment reports of military escalation started circulating, traders rushed into crude oil contracts, pushing prices higher within hours. At the same time, many investors began shifting money toward traditional safe haven assets such as gold, which historically tends to rise during periods of war, uncertainty, and economic instability. The reason oil reacts so quickly to conflict involving Iran is geography and logistics. Iran sits next to the Strait of Hormuz, one of the most important energy choke points on the planet. Nearly a fifth of the world's oil shipments move through this narrow waterway every day. If traders even suspect that shipping routes might be disrupted, oil prices can surge rapidly because supply fears spread across global markets. Tankers, insurance companies, and shipping firms begin adjusting their risk calculations immediately, which increases transport costs and adds a war premium to the price of crude. That premium alone can move oil prices dramatically in a very short period of time. In the United States, higher oil prices have direct consequences for everyday life. When crude oil jumps, gasoline prices often follow within days or weeks. American consumers begin to feel the impact at the pump, airlines face higher fuel costs, and transportation companies adjust their pricing structures. This ripple effect eventually moves through the broader economy, influencing inflation, consumer spending, and even Federal Reserve policy decisions. And that is why traders in New York and Chicago closely watch every headline related to the conflict. Gold tends to move differently, but for equally important reasons. Investors consider gold a store of value when global risk increases. During periods of war or geopolitical instability, investors often move capital away from volatile assets like stocks and into physical metals or gold-backed financial instruments. This behavior has been seen repeatedly throughout modern financial history. When uncertainty grows, gold becomes attractive because it is not tied to the economic performance of a single country or company. However, the gold reaction during geopolitical crises is not always straightforward. While safe haven demand pushes prices higher, other factors can sometimes limit gold's gains. For example, if the US dollar strengthens during a crisis, it can offset some of gold's upward momentum because gold is priced in dollars globally. In simple terms, when the dollar becomes stronger, gold becomes more expensive for international buyers, which can reduce demand. As a result, gold sometimes rises initially during breaking news events, but later stabilizes or even pulls back depending on currency movements. Another reason markets are reacting strongly is the uncertainty surrounding how far the conflict could expand. Investors are trying to determine whether the situation will remain a limited military confrontation or evolve into a broader regional crisis. If other Middle Eastern countries become involved, or if critical energy infrastructure becomes a target, the supply risks could become much more severe. In that scenario, oil prices could remain elevated for an extended period, rather than just reacting to short-term headlines. Energy analysts also focus heavily on shipping traffic and tanker movements in the Persian Gulf. Satellite tracking data and shipping reports are constantly analyzed to determine whether oil tankers are slowing down, rerouting, or delaying their voyages. Even small disruptions can create noticeable supply bottlenecks. Insurance companies sometimes raise premiums for ships traveling through conflict zones, which further increases the cost of delivering oil to global markets. For American investors and traders, this situation creates both risk and opportunity. Energy stocks often benefit when oil prices rise because higher crude prices can increase the revenue potential of energy companies. Large oil producers in the United States may see stronger earnings projections when global oil supply becomes uncertain. However, the broader stock market sometimes reacts negatively because higher energy prices can slow economic growth and increase inflation pressure. The bond market also plays a role in how the financial system reacts to geopolitical events. When global tensions rise, many investors shift money into U.S. Treasury bonds because they are considered one of the safest financial assets in the world. Increased demand for Treasury bonds can push yields lower temporarily, reflecting a flight to safety. But if oil prices stay high for too long, inflation concerns may eventually push yields higher again as markets anticipate tighter monetary policy. Another important factor in this situation is the strategic petroleum reserves held by major countries, including the United States. Governments sometimes release oil from these reserves to stabilize markets during supply shocks. Such actions can temporarily ease price pressure, but they are usually viewed as short-term solutions rather than long-term fixes. Traders know that strategic reserves are finite, so they watch carefully for signs that supply disruptions might persist. Technology and financial markets today react much faster to geopolitical news than they did decades ago. Algorithms and high-frequency trading systems scan global news feeds in real time and automatically place trades based on keywords and geopolitical developments. This means market reactions can occur within seconds of a major headline appearing. For everyday investors watching from home, it can look like prices are jumping almost instantly after news breaks. Another dimension of the situation involves global alliances and diplomatic responses. Markets carefully monitor statements from international organizations, government leaders, and military officials. A single announcement suggesting negotiations or de-escalation can cause oil prices to drop quickly because it reduces the perceived risk to supply. On the other hand, reports of additional strikes or military mobilization can trigger another surge in energy prices. Commodity traders also analyze futures markets to determine how long the price pressure might last. If short-term contracts rise sharply while longer-term contracts remain relatively stable, it suggests the market expects a temporary disruption. But if prices across multiple future months begin rising together, that may indicate traders expect a prolonged supply shock affecting the global economy. For gold investors, another key indicator is central bank activity. Some central banks increase their gold reserves during periods of geopolitical instability as part of long-term financial strategy. When central banks accumulate gold, it can support higher prices because they represent large, long-term buyers rather than short-term traders. This institutional demand sometimes amplifies the safe haven effect that occurs during geopolitical crises. The cryptocurrency market has also started reacting to geopolitical shocks in recent years. Some investors treat digital assets as alternative stores of value during global uncertainty. However, cryptocurrencies remain more volatile than gold and traditional safe haven assets, which means their reactions can be unpredictable during conflict-driven market events. Looking ahead, the next few days will be critical for determining how markets stabilize. Traders will closely watch diplomatic negotiations, military developments, and energy infrastructure updates. If shipping routes remain open and oil production continues without major interruption, prices may stabilize after the initial spike. But if supply disruptions increase, the energy market could remain volatile for weeks or even months. For Americans watching these developments, the most visible impact may be fuel prices and market volatility. Gasoline prices tend to react with a delay, but prolonged oil spikes eventually filter through to retail costs. Meanwhile, investors will continue balancing risk between commodities, stocks, bonds, and safe haven assets as new information emerges. One thing is certain: geopolitical events like this remind markets how interconnected the global economy has become. A military development thousands of miles away can quickly influence energy prices, investment strategies, and financial markets in the United States. As traders analyze every headline and signal, oil and gold will likely remain the two assets everyone is watching most closely until the situation becomes clearer.